Good morning. Thank you for joining me on the desk. Morning markets. The trading markets are alive and well today, and it really is stock specifics. We can certainly throw the Fed out there as a reason for some of the moves. There's now this 80% chance that the Fed is going to increase interest rates come their May meeting. But the backdrop to all of this is what we're hearing from the U.S. regional banks. And broadly, you know, if you're a glass half full type, you can say it doesn't look like they are falling out of bed, that they are collapsing, and on the back of some 20-30% declines on the stock, that they could be opportunities here. On the flip side, even with those big declines and some better than feared results, it's not enough to lead to kind of a resounding thumbs up for the sector. So that's kind of what we're going to pick apart today on Morning Markets. And joining me to do that is John Najarian. He's co-founder of Market Rebellion. John, thanks so much for being with us. You cover a lot when it comes to the U.S. markets. Right now, though, I want to talk about the regionals. You can talk about them as stocks themselves. You can talk about what they mean for financial stability generally. What's your interpretation, I guess, on that latter point? Because remember, we're so concerned post-Silicon Valley Bank. What is it telling you about this crisis?
Well, just as Warren Buffett and Jamie Dimon have said, the crisis probably isn't over, Amber, but I think there are some great opportunities here. I'll give you my quick disclosures on it. I'm long First Republic, I'm long Western Alliance Bancorp, which is WAL, and I'm long PacWest, PACW. And the reason there, and two of those three are big winners so far. First Republic, well, time will tell. But I like those because I think all they need is a little stability. As time passes, I think all of these become basically takeover bait for any of the bigger banks. And it doesn't have to be the big four. It doesn't need to be Jamie Dimon or the folks over at Bank America, Citigroup, or Wells Fargo. It could be KeyBank. It could be Fifth Third. I think that there's going to be some great opportunities in the tail end of the second quarter. And that's why I bought those, because just as you said, Amber, they were on sale. I like buying things that are on sale.
Well, but then you have to caution the pushback will be they were on sale for a reason. I mean, deposits proved to be something that no policy can really stem. If people are losing confidence in those three specific banks, that's kind of game over. And as to your point of, you could get a takeover, what makes you so confident that would be at any kind of premium to a shareholder getting in at these levels?
Because those in particular, like, for instance, First Republic is down 90%. So, yes, you had deposits leaving the bank. Yes, you had runs on these banks, not for the same reason, though, as the mismatch of duration risk, if you will, that really took down Silicon Valley Bank and some of the crypto exposure that the other banks that suffered similar fates. I don't think any of these three were in that category. But nonetheless, as you said, Amber, and I can't just dismiss it, the fact that you've got people nervous about various banks doesn't mean just because they fall that they have to go back up. But I think these three, and you look at Ken Griffith, he took a look at the balance sheet of WAL, Western Alliance, and he bought more than a 5% stake. I don't know if he's added to it or not. Ken, call me up if you if you'd like to straighten me out on that. But I think, that bank below $10 and then pops back into the $30 range, I think those kinds of moves are what you get if you're willing to basically take on some of that risk.
So you're going definitely towards the eye of the storm with those selections. And then there's those who look, stocks that, that whole baby thrown out with the bathwater thing. And that's what brings me to M&T Bank, another regional that is down, but might have been unfairly put in that category. When you look at the results, they certainly showed up, some of that deposit weakness there. You're not getting much of a lift in the stock. Are you taking a look at these names too, like something that was unfairly thrown out?
I certainly would, but I have not pulled the trigger on any of those others. These are the three that I picked, and I picked because of the strong relationships they have had. Obviously, First Republic is a spin out. and did quite well on its own for years and years. I think that's one of them, like I say, that as time goes by, to borrow from Casablanca, I think this one looks better and better. All three of them, I think, survive. The government doesn't want to put them out. There may have been, a little bit of that attack on some of the banks that were more exposed to crypto. But these were basically suffering because of what people saw on TV, the lines and the runs and all of the discussion about whether Silicon Valley Bank or Signature were going to survive. And that's why people lined up to pull their money out. That's why they were pointing and clicking for electronic banking and taking and transferring those funds to other places.
John is going to stick with us for the next half hour, but I'd love to bring in Gerard Cassidy into this conversation. He's head of U.S. bank strategy at RBC Capital Markets. Gerard, you're a buyer here of M&T, and are you surprised, given the results didn't show that, they're falling out of bed in any way, and that the stock is already down some 20 to 30%, that we're only seeing a modest reaction to the beat here? What's your analysis of M&T today?
No, it's a good question, and I would say, yes, we are surprised that the stock's not behaving better today in view of the fact, as you pointed out, M&T and many of its peers have suffered dearly since the Silicon Valley fallout. And so as we look forward, I think investors are looking at more than just one quarter before they jump in with both feet. And so we anticipate that M&T, if they continue to deliver results that are strong today, yes, you pointed out, and I agree that deposits were down, particularly the non-interest bearing deposits, as more people move the money into interest-bearing accounts. But that being said, the company still has held a 4% net interest margin, which most banks cannot achieve. And this company is, over the long run, has done extremely well for its shareholders. It's well capitalized. It's going to continue with its buyback, and we would expect it to rise above the top over time.
It's interesting you say you're really talking about the style of investor that's going to be getting in here to M&T Bank. You got to have that long-term horizon. What are your conversations right now with investors about the U.S. banks? I mean, you would think that we would see kind of a sharp re-rating, but it sounds like your conversations with them suggest that this is going to take some time to rebuild.
I think it will. And when you talk to the more short-term investor or the hedge fund investor, they are certainly looking for a bounce here in this quarter, as the numbers aren't as bad as the stocks maybe are suggesting in terms of coming into the quarter from a price action standpoint. But the long onlys, the large mutual fund owners, they were big sellers, we believe, right after the Silicon Valley debacle, and they have not come back yet. And I think it's going to take them more time to get comfortable with that the banking system is stable. The contagion that some people were expecting following the Silicon Valley and Signature failures did not happen. And in fact, last week, when they reported deposits by the Federal Reserve on Friday afternoon, deposits were up for the smaller banks. And that's a really good sign that, the worst we think is over on this deposit flight that we saw following the Silicon Valley Signature failures.
And maybe people were looking in the wrong place when they were looking at deposits. I mean, maybe we can throw State Street in there, which is a bit of a different beast, more of an investment manager and custody bank. It saw huge outflows, and you also saw, declines in deposits at Charles Schwab. You're not a buyer here of State Street, Gerard.
That's correct. The State Street numbers on their call, they gave guidance that the net interest income in the second quarter, and that's basically the spreads that any bank earns over, their earning asset yields less funding costs. They expected that they expect net interest income to decline 5 to 10% sequentially, and that was a big surprise. And the reason being is State Street, as you pointed out, is a different type of bank. It's a custody bank, and its primary customers are institutional investment firms. And therefore, those investment firms are very sensitive to interest rates, whereas M&T's core deposit customer is what I like to call a grandma and grandpa account that has $5,000 to $10,000 in it, and it's not very interest sensitive, whereas the institutional accounts are. And as State Street pointed out, they're losing their non-interest bearing deposits at a faster rate than they expected as that money moves into interest bearing, and therefore they're going to have lower net interest income, which is why the stock is down so much today.
John, how are you looking at the State Streets, the Charles Schwabs of the world, kind of within this lens that you have about, we're trying to figure out where the next thing could happen within the financials?
Well, I think in particular, of course, just like Gerard said, it was really the Schwab. That was a run on, a brokerage firm that is also a bit of a custody bank, if you will. I don't think that the stock deserved to fall from 72 to 47 or whatever the bottom was there. It's not far off of there, though. It's only managed to climb back a little. And that's because the money that came out hasn't been rushing back in. So they have earnings coming up. I think that's one that we will definitely watch. On weakness, I would take a shot on that, on Charles Schwab, on weakness after the earnings report. But right now, that is not one of my primary focuses. I think he's right about State Street and MT, and both of those, M&T and State Street, didn't fall nearly as much as the ones I was talking about previously.
Gerard, I'll give you the last word on the financials. Looking at what you cover, broadly, you're a buyer. You're kind of cherry picking the names to avoid, but you like the large caps and you like the regionals. What's underpinning that?
I think what's underpinning it is that the stocks have sold off very hard since the Silicon Valley debacle. And I think it's been too much. And when you look at the underlying profitability, even though I know investors are now increasing their focus on credit quality, particularly in the commercial real estate area, but as we try to point out to investors, the exposure the U.S. banks have to commercial real estate is not that material. It's manageable. And with these net interest revenue numbers, they'll be able to handle the higher levels of credit costs that we expect this year as credit normalizes. We all know that in 2022, credit quality for the banking system was extraordinarily strong. And it's just naturally going to have higher costs, and the banks can handle that. But in view of the fact of where they're trading, many banks are trading below stated book value. We think they should be trading closer to 120 to 1.2 to 1.4 times book. And there's upside here for investors by owning these stocks at these levels.